across the world, the major markets, the share markets are all losing between 10 to 20% over the last few months. What might happen to the capital markets over the next 9 months? What should you do and how should you traverse the share market? And in this video, I am going to touch upon a very sensitive topic. How should you invest in the share market over the next 6 to 9 months? Now, this video is going to divide it into three parts, and I recommend you listen to all three parts because it will be useful to you. So, in part one, we will quickly see what has happened to the markets over the last few months and why is it happening. Part two, we will look at what might happen to the markets over the next 6 to 9 months and what are some of those reasons. And part three essentially will be my recommendation to you in terms of how you should navigate the share markets. Now, before we start, do subscribe to the channel and click on the bell icon. So once you click on the bell icon, next time when I make a video, you'll come to know about it anyway. Now, let's start with part one. What has happened in the markets and why is it happening? So if you look at the BSE, the Bombay Stock Exchange, which is a flagship index, it was at around 61,000, a high of 61,000 a few weeks back. And as I shoot this video, it has reached 54,000. So it has lost about 7,000 points, about 12 to 13% loss in its value. If you look at the American markets, and a lot of Indian markets are linked to the American markets, the NASDAQ over the last few months, which is a tech-heavy index, has lost about 25% as I shoot this video. The S&P has lost about 15%. So across the world, the major markets, the share markets are all losing between 10 to 20% over the last few months. And let's get into the reasons. Why are some of these global markets losing their valuation? It's very interesting to understand, and only basis that can you predict what might happen in the next 6 to 9 months. So one of the big reasons is obvious, is because of the Ukraine-Russia crisis that is going on. As I shoot this video, the war is in a stalemate. No one really knows what's going on. The reason it is pushing and crashing the share markets everywhere is because Russia is a big source of big supplier of oil. A lot of European nations are slowly putting an embargo on Russian oil. So inflation is actually shooting up. The other thing is Russia and Ukraine are considered the wheat basket of the world. So 12% of all your food across the world actually comes from these two markets, and the lines are getting disrupted, and hence food prices and oil prices and everything associated with it is going up. So what you will see with inflation numbers is in the US, the latest inflation number as I shoot this video is 8.2%. It's one of the highest in the last 40 years. Even in India, the consumer price inflation is hovering between 7-8%, but the wholesale price inflation is actually shooting up. Now, also as a result, to take care of this, you've seen the US Fed, the Federal Reserve has increased the benchmark interest rate by 50 basis points. That's 0.5%. And it's one of the highest increases in about the last 30 years. Now, what happens, you have to understand why the stock market, especially I told you the NASDAQ has crashed 25%. Why does that happen? Because for a lot of tech stocks or a lot of companies which have future growth, the price of the share is inversely proportional to the interest rate. So if the interest rate rises, what you're essentially saying is the future money, I will discount it much, much more, and hence the existing valuation goes down. A lot of these high growth companies, tech companies are all about the future. So when the interest rate rises, the valuations start coming down. So that's one of the also the reasons why the share markets are crashing the world over. The other reasons why the share markets are crashing is essentially the lockdown in China. As I shoot this video, Shanghai is under lockdown, although it is slowly releasing. Shanghai is a major port. Now, Beijing, there are a lot of cases, and Beijing might go under complete lockdown. And because of that, a lot of critical items in the supply chain have got disrupted. Now, if you look at India, because of inflation in rural India, a lot of rural demand is going down. So if you look at the results of companies in FMCG and apparel and automobile, consumer electronics, rural is taking a bit of a hit. Rural is not growing as fast because people are feeling the pinch on their pockets. So some of the results of these companies in which are rural centric are not doing that well, and hence that's also one of the reasons why the share market is coming down. So this is part one in terms of what has happened and why it has happened. Now we will move to part two in terms of what might happen to the capital markets over the next 9 months. Now, the big thing you'll have to see is, you might have heard, Goldman Sachs has come with a report that there's a very, very high risk that the US economy will enter recession. Remember, the US economy contracted in the first quarter, but now they're saying there's a very, very high risk that the US economy will enter recession. And for some of you who've seen the 2008 crisis, I saw it very closely. It is said when the US sneezes, the world catches a cold, and this time it might be a little more than a sneeze. So if the US enters a recession, what typically happens is capital flows from the emerging markets to the developed markets. So a lot of investors think, let's move to safer shores, and the US is seen as the safest shore. If you look at what's happening in the Indian markets for some time, the foreign capital is moving out. And if the US enters a recession, as it is very likely, you will see more and more capital that will start moving out. So what are some of the agencies saying? If you look at IMF, although IMF is saying India will grow very fast, every month their estimates are actually coming down. The latest estimate IMF has for India is that it will grow at 8.2% over the next year, but these estimates are coming down significantly. Also, like I mentioned earlier, the Federal Reserve in the US has increased its baseline interest rate by 50 basis points, but there is an expectation that it will have to do much, much more to keep inflation under check. And the more it increases interest rates, the more the American multiples will collapse, the more capital will flow out, and more the correction that will happen in the Indian markets. So, given all of this, and this is my personal suggestions, but before you take any advice, do your own research, look at which stage of life you are, how much risk taking capacity you have, how much debt you have. But my suggestion, and you obviously have to customize this for your stage of life, are the following few points. One, do not discontinue your SIPs. If your SIP has been performing for the last few years, do not discontinue that right now, because the market might go down in the near future. Continue with that, because you are actually buying it at a lower price. And eventually, when the markets recover, you will get a very good deal on it. So when you are investing now over the next 6 to 9 months, know that you might not get a good return for the next 5 years. So keep investing in SIPs, good SIPs with a 5-year horizon in mind. The second piece of advice I have for you is, a lot of you might receive your annual appraisal bonuses right now. It might be a significant sum. It's the month of May, June, July. A lot of companies pay out their bonuses now. Do not invest that lump sum into the share market. It's a huge, huge blunder you're making. So what can you do with that money? If you have any outstanding debt, credit card debt, if you have any home loan, try and clear some of that. If you do not have any debt, put that money into PPF, put that money into NPS. PPF, you can put 1.5 lakhs every year. NPS, you can do at least 50,000 and much, much more. Put that money in those safe instruments. The third piece of advice I have is, do not try and buy individual stocks this year. What happens is, there are so many fintech players in the market. They create these fancy apps which are very easy to use. You can buy shares, buy derivatives, sell derivatives. I think this year you should stay away from it. Unless you are a professional trader, you should not invest directly into stocks. You have your SIPs, let the fund manager, who has all the resources at his disposal, think about that. The fourth piece of advice I have for you is, if you have a major investment that's coming up in 2 years, say you have to buy a flat, or you are going abroad for an education and you need a lot of money for that education fee, try liquidating some of those equity investments you have right now. So whatever equity investments are, every month try selling a bit, so that in about 18 to 24 months, your large lump sum which you have, you can take care of. So here are my 4 pieces of advice in terms of how you can navigate the share market. What other questions do you have, or how else do you think the markets can be traversed? Do drop them in the comments box, and I will try and reply to as many as I can. Before we finish, do subscribe to the channel, click on the bell icon, and till next time, take care.